Bank stocks are some of the most popular in Australia, especially the Big Fours: National Australia Bank or NAB, Commonwealth Bank or CBA, Australia and New Zealand Banking Group or ANZ, and Westpac. The stocks of these four banks have always been considered by many Australians to be a better substitute for annuities due to their massive profits and generous dividends. But with the coronavirus pandemic wreaking havoc on all businesses across the globe, the banking sector has received a strong blow. And the question is it worth to invest in bank shares now? In this episode, we'll dive into this topic and try to answer this question in 5 comprehensible points. Let's get into it. Number 1. How are banks affected by the coronavirus crisis? First of all, the pandemic has only added to already mounting issues that have been plaguing the Big Four for quite some time. These include the requirement to hold significantly more capital than ever, which means they have less to spend and make profit from, plus a tsunami of additional regulatory risks. With interest rates at record lows and Australia entering its first recession in 3 decades, bank stocks have witnessed a drastic decline in prices. Since January 2020, the Big Four's share prices have dropped an average of a staggering 20%. Adding to their woes, major banks have been forced to delay or even entirely cut dividends to shore up company profits, which is making it much less attractive for investors to support them with their money. Moreover, there's currently about $210 billion in deferred loans, ranging from business loans, personal loans, credit cards, and residential loans. Truth is, businesses and mortgages are going to have to start repaying debt once the hibernation stage of the COVID-19 crisis ends. But it's increasingly worrying for banks that this payment holiday is likely to go on longer than anticipated. The longer the repayment of these loans are stalled, the more damage banks have to sustain, especially with the cost of deferring business loans continuing to mount. However, there are some good news. Undervalued stock prices make it very attractive for long-term investors to buy, which is going to help the banking sector make a recovery. Also, unlike the 2008 global financial crisis, when the official cash rate was lowered to around 6%, today's super low borrowing costs make it easier for banks to take a wait-and-see approach to potentially problematic loans. This explains why only a fraction of the $210 billion in deferred loans are expected to default. Adding another layer of comfort for banks, the much anticipated and widely predicted crash in housing prices hasn't come about. In fact, residential property prices have risen slightly since April. Number 2. Are bank dividends still a suitable substitute for fixed income? The net effect of the issues we've just explained in point number 1 is that the attractive dividends investors could previously rely on now look much less certain. So the answer is, we don't know. And that's saying something, because just a few months ago we did know they were definitely a better substitute. Dividends are a big deal for bank investors because major blue chip stocks don't always see their share prices rise as much as growth companies like Afterpay or Zip, so they rely instead on dividends. Although banks generally report substantial profits, dividends paid from earnings aren't likely to be positive when there's a recession. Which is why the market is now rightfully questioning whether Australia's multi-decade obsession with the Big Four banks is still warranted if their dividend levels are unsustainable. For income investors who have treated bank dividends like annuities, this is a tough question to ask, especially with cash and bank deposits offering such miserable returns. Unlike the global financial crisis, the banking sector, and especially the Big Four, will not emerge from the great virus crisis unharmed. Federal government pressure on banks to extend questionable loans to help companies survive the crisis has forced the Big Four to increase their provisions of loans going sour. And with $65 billion of retail property loans sitting on their records, the bulk of banks' impairments will come from the commercial property sector, where landlords and tenants are currently involved in a massive dispute over mandated rent relief. Now, the question remains, do the Big Four's stocks remain an alternative to term deposits? At face value, it looks like a no-brainer. After all, with the Reserve Bank of Australia's official rate at 0.25%, deposit rates will be at a dismal 1.25%, which means that after we take inflation and tax into account, investors will be out of pocket by around -1%. That being said, shareholders are likely to receive a much lower interim dividend this quarter, or no dividend at all, a fact that makes holding bank shares much less compelling. ANZ and Westpac have deferred their dividends completely. NBA paid an interim dividend of 30 cents, which is 64% down from 2019, and CBA is expected to take a scalpel to its dividends in August. While the information we currently have at hand offers little comfort, the real question for investors and shareholders is how long will bank dividends be deferred for, and will a lower dividend policy become the new norm? Only time will tell. Number 3. Have banks been oversold? Meaning, are their stocks currently trading below their true value? Intuitively, the short answer is no. Banks know better than anyone it's going to be impossible to maintain investor support without the appeal of above-average dividend profits. The banks entered the global virus crisis with the most robust balance sheets ever, courtesy of the Australian Prudential Regulation Authority's tighter lending measures. So, one can argue that they've been oversold on the expectation that the COVID-19 downturn will last for long. But assuming the crisis has only a short-lived effect on book quality, many are predicting that banks look well on their way for a near-term rebound. Based on its thorough analysis, multinational financial services company Goldman Sachs suggests that banks can sustain a decent 10% return on equity in the current environment. This is good news for investors because it means the payout ratio for dividends will soon be a respectable 72%. Number 4. Are major bank stocks a bargain? To elaborate, are these stocks currently trading at lower values than their real worth and are expected to bounce back soon? Well, although shares of the major banks are currently much lower than they were at the beginning of the year, they've staged an impressive rally since April. After crashing by 35% between February and March, CBA's share price has risen by about 16% in only 4 weeks, from the 20th of May to the 20th of June, and the others have seen even bigger recoveries. Since the 20th of May, Westpac, NAB, and ANZ have all seen share prices lift by over 20%, and now some analysts claim they're back to being overpriced. Overpriced means that if you buy at today's price, you're unlikely to get much in returns in the next 12 to 18 months. Analysts believe that bank stocks have mostly recovered from their March falls and are unlikely to rise much further this year. Number 5. What does the future look like for banks? Truth is, the banking sector was amongst the heaviest hit at the outset of the crisis. We believe we're coming out of the other end of it now, and that naturally means that the worst for bank stocks is probably over too. That being said, the business environment for banks will remain quite challenging. Weak macro fundamentals, tighter credit regulations, higher risk, and low long-term interest rates are going to be considerable setbacks. In the slightly further future though, over the next 5 to 10 years, the outlook for bank shares is probably slightly better. Final tip. That was it for our 5 points explaining how bank stocks are doing in Australia right now and the predictions for their future. And it's time for a quick final tip. If all this stocks talk excited you to buy some shares in banks, but you're not sure which bank to invest in, it might be a good idea to buy exchange trades funds or ETFs, which focus on banking and financial industries. You can own multiple bank stocks using only one stock on the Australian Stock Exchange. 2 examples you might want to look at are BetaShare Australian Financial Sector ETF and VanEck Vectors Australian Banks ETF. That's it for this episode. We hope it helps you all out there managing your investments. If you want to know more, check out our other episodes on value investing and investing during a recession. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Let us know if there's anything in particular you'd like us to make an episode about in the comment section below. We hope you all make it through this crisis with the least amount of losses. Stay safe and good luck.